Enjoy your meeting. Just a reminder, today's meeting is being recorded. All guests are no longer muted. All guests have been muted.
Hey, good afternoon, everybody. This is David Blake with Tuesday Tech Talk. Sorry we missed it last week. Had some things going on. But we're going to quickly review the last few days, try to figure out what the market wants to do over the next, the rest of the week. After that, we'll look at the different indexes and kind of determine some support and resistance areas, try to identify sectors that might be ready to lead the way higher or might be telling us there's a little bit more downside to go. If you're new to our Tuesday meetings, we welcome you. What we do is I talk for about 20 to 25 minutes, and then we open it up to you and talk about anything you want to discuss on individual stocks, maybe industries, targets, or anything else that's on your mind. Okay, today we want to talk a little bit about what's been going on here the last week. Is this still a counter trend rally, or is the bottom in, and is this going to be the real thing? What we want to try to do today is look at the different indexes, look at the numbers that will determine whether it is a rally or whether it's just a counter trend rally. So last week, the major averages turned in their best percentage performance of the year. They bounced off oversold levels to reach or nearly reach the highs from February 1st. Yesterday we saw the Dow actually was the first index to take out the high from February 1st from the last bounce. What we saw traders saw that China's Shanghai index had stabilized a little bit. It hadn't fallen out of bed. And yesterday's 200-point rally in the Dow, which was triggered a lot by China's top market regulator stepping down. He's been a concern to traders, bringing some volatility to that market over there. And also, we've seen some stabilization in crude oil. As we had some tentative agreements between OPEC and non-OPEC countries to cap production, even though they are at January's record output numbers. But crude rallied again yesterday, so the market is still tied to that. Today we're seeing crude fall off about 5% again, kind of erasing yesterday's gains. But that's taking away from yesterday's rally. We're down about 162 points. So yesterday's rally with the Dow, which kind of stalled out at the 50-day moving average, has pulled back again. So let's kind of watch to see if this is just how temporary this is. And okay, first chart we want to look at right here. Actually, before I mention this, last week we also saw the Dow Jones Transportation Index was the first index to pull back, trade back above its 50-day moving average, and it actually held it. I'm not sure today. I'll have to take a look at it because we're down about almost 100 points in transports today. But that's been the best performing index for the last week or two. That's a plus going forward, as the transports pretty much, as we've been talking about over the last year basically, led the market lower. And we're hoping that maybe they've put a bottom in and they will lead the broader market higher at this stage. So most of the underlying indicators that we've been watching for the major averages are in pretty good shape in here. We'll look at those as we pull up the charts. Internal breadth numbers for the NYSE and NASDAQ have shown marked improvement over the last few weeks. And we've had a real turnaround in the number of NYSE new 52-week lows versus new highs. We actually, where we had almost 500 new 52-week lows about 2 weeks ago, that has flip-flopped, and on the last three of the last 4 days, we've actually had more new highs and new lows on the NYSE. NASDAQ isn't quite there yet, but it's close, and we have seen marked improvement in that also. So what we're going to talk about now and discuss is whether we're in a counter-trend rally, or is this market going to go lower and or have the bulls wrestle control or whatever. So we're going to look at a couple of charts. I'm going to throw out something that I hope you've heard before. That is, whether you think this is a counter-trend rally or a correction or a bull market, it doesn't matter to us whether we're right or wrong. In technical analysis, you change your opinion as soon as the chart says that the trend has changed. So keep that in mind here while we're looking at these charts. We're not looking actually for new trends that have begun. we're looking for areas that could provide support and resistance as we have these counter trend rallies. Okay, the first chart is the Dow Jones. Let me get my little pointer up here. Okay, the Dow Jones peaked last May over here at about in May of 2015. We've come down and tested this 15.6 level a couple times over here now. Actually made a new 52-week low of closing low of 15.660 less than 2 weeks ago. So we're still, actually, as far as looking at closing prices, we're still making lower lows and lower highs. Now, Monday we flirted with the 50-day moving average. We did actually trade above the high from February 1st, which was good. Here's the moving average of the 50-day right over here. Hit that and kind of bounced off it. Let's see. If we also, if we look at this, the 50% from the high to the low, 16.9 comes into play right around here. This is the 50% retracement move from this high all the way out to the recent low. So I believe with the underlying indicators, we should be able to crack through this 50-day moving average over the next day or two, and then we're going to run into some resistance up here around 16.9. I think the market should probably not have any problem in getting that. We're seeing some positive divergence down here on the 14-day RSI. We should get a buy signal on the MAC long term here, which is kind of an intermediate term trend identifier. And although the market's overbought, this is a 30-day stochastic that I look at for momentum. We are almost in the high 90s even on that, which means that we're due for a pullback. So today's action is healthy as long as we don't just fall out of bed here and go down about 300 or 400 points. But I think this is telling us that we should get a rally up in here that would take it to the rally point that we made back in September before we pulled back. And that would also, it's kind of halfway in between the where the 200-day moving average is also. Now, one thing I also wanted to notice here is you'll see a double line in this. And what this is, this means what you want to look for in Fibonacci retracement levels is if you can draw the Fibonacci retracements in, and you get a convergence of several different lines, like maybe the 50% for the total move versus this over here. This is the 38.2% retracement down of this total move from here in December. That adds significance to that line, and that's why I think that this rally is probably going to struggle a little bit at that 16.950 area. If we can break through that, of course, then you've got some more troubles up here, the 17.2 area, which is a 200 moving average. But I would say at this point, if we can hit 16.9, I would certainly be thinking about taking some money off the table. That if the rally fails there and we come back to a setup that includes lower highs again, we'll have to see if we take this out. But we could actually even be in a sideways trading market for this. But until we can take out around 18,000, we're still in in a series of making lower highs. So until we get to 18,000, you have to consider this a counter trend rally and not the start of a new uptrend in this bull market. We've had several lower highs. Now we've had the lower lows. Okay. Before we move on to the indicators that are bullish, they're mixed in here. The short-term indicators over here are mostly positive, but the longer term, I want you to take a look at over here. This is actually the Dow Industrials going back to the beginning of this bull market back in 2009. This is a line chart, and it's using closing prices also. And over here you can see where last fall, where we broke this long-term trend line that had been in place. Okay, we rallied back above it shortly after the central banks promised to rescue everyone, and then we traded down here, bounced off it a couple times, and we broke it here back in January. Okay, as you can see, the long-term technical indicators are still very bearish down here. But here's a different way to look at the 14-day RSI. This is, even though we made a lower low on the closing prices of the Dow Jones, you'll see that the 14-week RSI has made a higher low, which shows positive divergence. So that's a good sign that and actually quite a good signal that we are probably going to get a higher bounce up in here to this possibly a 16.9, 1700 area. And that would be something I want you to keep an eye on that. Now, what's also negative about this chart that you want to look at is number one, generally in a bull market, even on a long-term and a short-term trend market, you want to see the 14-week or 14-day RSI stay above 40 if you're in a bull trend. And also, it'll continuously go up to maybe 80 or so. As you can see back in here, we got up in the 80s, up in the 90 back here. Over here in September, we actually broke 40 for the first time. We've held it so far here, but we were unable to get above 70. And if the RSI can't get above 70, it still kind of tends to people traders to believe that you're probably still in a downtrend until you can break above that 70 level. Now this RSI comes back down and takes out the 40 level again, and we go back to the 30. It's going to also confirm that that we still have some work to do, possibly on the downtrend. Okay, right over here. Because we close on a weekly basis below this 15,836, which is where the 200-week moving average is. Okay, that's going to nullify the last 2 weeks, and that would be -4. So you want to watch that area if we do get another pullback. And if we do crack below this area right here, this 15,830 or so on a closing basis, on a weekly basis, you're probably going to want to sell into that and probably consider we may want to be all out, because that's going to open the door down here to about 14.5 or so, and that would be kind of a worst case scenario. But that's kind of the numbers you want to watch on a closing basis at 15,830. Okay, the next chart we want to look at is the S&P 500. Okay, I won't spend too much time looking at this one because it's basically the same short-term chart as you're going to see on the Dow. I just want to give you the numbers to watch here. We have resistance at the 50-day moving average over here at 1950. Didn't quite make it over there yesterday, but we also have two 50% retracement levels up here around 1970, 1975. If we can bull our way through that area, then you've got another resistance area up here around 1990, 2000 area, maybe 2010. That's the 200-day moving average. So you've got a lot of resistance coming up here to get up here before the actual trend actually changes. Okay, now if we break above that, up at this 2065, 2070 area, we have a good shot at going to new highs. But a lot of resistance in that area. I think if you can get up to this area, you probably want to start to lighten up on positions. Okay, again, until we get up to about 2025 or actually about 2080, we're still in a series of making lower highs and possibly lower lows. So I didn't say this earlier, but remember in 2015 we defined these areas and then we stayed in the trading range. And again, that's the third possibility, is that we trade back and forth in here until we can break out one way or the other. Okay, the next one here is the S&P longer term chart again. As you can see, we held up here, bounced off here several times. We actually didn't break the long-term trend line in September. However, we did break it here in January. Yes, now we've come up to this longer-term trend line, and we've failed so far to break above that. That's something you want to watch. As we look at some of the other sectors, we noticed, like especially last summer, when they would break the long-term trend line, they would maybe rally back up to the line, and they would roll back over, which was a worst-case scenario. Okay, so what the market fails here, we sell a little bit, play around this 1800 area where we have the 200-week moving average. If that is broken, that's going to open the door down here to the easily reach the 1650 area with a worst-case scenario. You come all the way back down here to this 1425. I don't think that's probably going to happen, but this area down here around 1650 is a possibility if this thing rolls over again, what we're in here right now. I'm not trying to scare you, but what we're looking here for is the areas is to break. When they break, this is the targets that we would have for these things. So, I tell my son all the time, you want to prepare for the worst and hope for the best. And what we're going to hope here is that if we do come down here again, we stop at 1800, 1810, and can bounce back there again. Okay, here's the NASDAQ. So it's probably had been one of the worst performers here since the middle of July. Where are we at over here? Somewhere. Okay, here we are. We came up here on Monday. We got to almost to the February highs, not quite. We still have a ways to go up to almost about 4680 or so on the they get to the 50-day moving average. We also have two Fibonacci 50% retracement lines coming in there also around that 4,700. But I think that's probably going to be our next target, which is right around the 50-day moving average. That's probably a good possibility we do. Now, if we do go nuts and we can crack through there with some good volume and things are starting to look good, then we can get a run maybe to that 4,800, 4,900 where the 200-day moving average is. That also represents a 61.8% Fibonacci total for the total move from down here and from also from the November, December highs. So we want to watch that. We're getting some nice positive divergence down here on the 14-day RSI. Momentum on the 30-day stochastic oscillator has crossed in the bullish territory. So these are telling you that we probably have a little bit more room to go. Even if despite today's fall back, you're not really even testing. You're down here testing 4,500. That seems to be a confluence of where we've stopped before. But I think you'll probably see a run over here over the next couple of weeks with the positive divergence in that. Now, if we look at the weekly NASDAQ, see what happened here. Okay, here we go. Okay, you can see the NASDAQ was actually in better shape. Going back to 2009, this long-term trend line, we haven't even really hit it yet. It's going to come in around 4,200 or something like that. We haven't even tested that, but I think if we continue to go down a little lower, at 3,900 to 4,000 area would probably be the target where we could hit. I don't see, unfortunately, on the longer term NASDAQ, which is telling us we may go a little bit lower. I don't see the positive divergence you see in the RSI. And also the MACD isn't close to giving a buy signal yet either. Also the stochastic momentum is still in negative territory. So it's looking a little weaker in the longer term, looking like it has some more work to do on the downside. But this counter trend rally that I believe we're in right now could take us up to that 4,800 level, 49 almost, before we would struggle to go a little bit higher. So you want to kind of watch that in there. Okay, the next two indexes I want to look at are going to be the Russell 2000 and Dow Jones Transports, and both of those already have made it down into the bear market territory. We want to see if they're telling us anything because, like I said, they are the ones that pulled the broader market down, led the way down. Now maybe they can bottom first. If they can bottom first and signal that we're in a new uptrend, that could give a little bit more rise to the broader market. The Russell 2000, which you'd like to see as one of the leaders of the broader market, made another lower low here about a week and a half, 2 weeks ago. It's still making lower highs. So the major trend is still obviously down. We're looking at resistance coming in here around 1050, 1060, where the 1050 to about 1080, I guess, is where the Russell found support back in 2015 in the summertime, also back in October. We also talked about the polarity over in here. This is that 50% retracement of the total move down. Comes in about 1080. That's where support now becomes resistance. So just above the 50-day, we have that. If we can get some oomph behind this market, make a run up above 1100, you have two Fibonacci retracement levels over here, a 50% from the total move, and then another 31% off of this low, off of this high to the low back here in December. That's going to obviously be another area of resistance that we'll have to get through. And then you've got to come up here again and try the 200-day. So again, you've got about 3 or 4 areas of resistance on that. I do see some positive divergence on these. Also, the MACD has gone positive. Stochastic 30-day has gone positive. So this has a ways to go. I think you're going to see this at least get up here in this 1075, maybe 1080 area before we can. You might consider pulling off some profits on that thing. Next one is the Dow Jones Transport. Oh, here's the long term again. I'm sorry about that. The longer term on the Russell. You can see back here we broke the long-term trend line on this back in October. Over here we broke it again in January. We broke through the 200-week moving average. Over here you can see we actually have retraced that 38.2% retracement level of this whole move from back to 2009. It did find support there. That's good. We want to see that. A break below that could open the door to fall down to around this 820 level or so. But as of right now, as long as this holds, we're in decent shape. A little bit of positive divergence on the RSI. The other indicators, not so much. They still look pretty negative. But we want to see that this rally can at least get above this 200-week moving average and make it run up to maybe 1,100 or so to show that the small caps are leading again. Okay, last summer we talked a lot over in this area right here how we wanted the Dow Jones Transportation Index. If we could have broken through this area and got above the 200-day, it may have pointed that the market had bottomed and we'd head on up. Unfortunately, we hit that just shy of the 200-day moving average, turned around and collapsed, took out the lows from August, and made a new low here just about 3 or 4 weeks ago. If we're going to see the broader market make new highs or at least get up towards the old highs, we definitely have to see this thing improve. Now, we did see it cross above the 50-day moving average about a week and a half ago. That was great. We're up here at the 7,400, which is a 50% retracement of this move down from December to a couple weeks ago. And also it's a 38.2% fib line also for the total move from about 2 years ago. So this is a significant resistance at this level right here. We actually got to this level yesterday. We've pulled back here to 73.20 something today, which is right about here. I think we'll probably get another shot over here, especially if we can see the crude oil prices firm up a little bit, and probably get a run up here to around the 7,800 area. It's going to be tough for this thing to get through that area, I think, right below the 200-day moving average. We'll have to see what happens over that. But if it falls over here, that would be another negative sign for the broader market. Boom, if we could get through that 200-day moving average and make another run towards the summer highs, that would be positive. You are seeing a lot of very positive momentum action on this. It is overbought, considering whether you're looking at the RSI or the stochastic. And we also have a buy in the MACD. So that's telling me that we are at least probably going to get up here around this 7750, maybe 7800 area over the next few weeks. With the rest of the market, I think we could, see a little bit, see some higher prices over here. Longer term, here's the longer term. We just actually, even though it kind of outperformed going in here in 2014 and early 2015, but we did break the longer term trend line on the transports and the 200-week moving average, bounced off of this 38.2% and came back up to the trend lines, which is where we are right now. We want to see that break back above that trend line. That would be bullish for the broader market and maybe prevent this the 50-week moving average from doing a golden cross down here in a couple of weeks. But I don't see the positive divergence that we see on the shorter-term trend on the longer-term chart, which is a little bit troubling. And I was still on this type of a move. I still like to see some of these momentum indicators show a little bit more pop than what they're showing right now. So we are seeing possibility that could be a bottom, but it still needs some work. We want to get this thing up around 7,700 or 7,800 before the debt transports, before we kind of blow the whistle. Okay, 2 more charts I want to look at before we start looking at some of the sectors real briefly. This is we look at these all the time. This is the NYSE Advanced Decline line, and what you're going to like on here, we have a nice double bottom basically in this chart, and we actually for the first time have made a higher high off of this. This is the first one. That's some more work to do. But we've also picked up about 8,000 or 9,000 units over the last couple of weeks, which is very bullish. Which means a lot of participation going on with this. The NASDAQ doesn't quite look as good. As you can see, we really bottomed out over here about a week and a half ago when we made another new 52-week low, and now we haven't quite been able to go above the highs over here on the AD line from just from a couple of weeks ago. So some improvement, not enough to signal that the market's under heavy accumulation or anything like that. So we can watch this. Of course, you can find these last 2 charts on the Market at a Glance homepage. Okay. 2 other charts we want to look at real quickly. We had 3 people call in and wanted to talk about this. This is the oil fund. USO is the symbol for this ETF. And what this is showing you here, of course, we have kind of a little bit of a double bottom over here, a little bit of a rally in this area. It's kind of reversing today. The 50-day moving average on this on the USO is up here around $9.68. This actually was upgraded to a neutral from a void on the second opinion. Whether this is going to be quite a battle. Now, this will probably be around $36 for regular oil, for oil futures, the crude oil, to get up to this area. I'm not sure we're going to be able to get much higher than that. If it does, maybe you get a run up here to the $11.50, $12 on the USO. But that's one, we want to see positive, divergence on this. We're not seeing a heck of a lot of accumulation down here on the up-down ratio down here. This shows you whether they're buying it or selling it. It's just kind of going flat from here. But the RSI is struggling to go positive. It keeps bouncing off this 50 area. Again, for this to be in a bullish trend, you want to see this thing at least get up here and get above 70 on peaks. We haven't seen that yet. Okay, another thing that we want to look at, this is the GLD. This is the gold shares. Of course, you saw this this rally off of this. This is actually a 2-year chart. But what you can see, and which I want you to see here, is that we have broken a longer-term descending trend line. We're very overextended on gold. It's up again today about almost 3%, actually about 2%. I'm sorry. And you could probably look to add, if you don't have it already, buy some positions down here on GLD around 114, 115, somewhere in that area. Today it's at today we're right around not sure. Well, around 155 today. Is not coming up. Okay, but anyway, if this thing can crack through this 120 to 50% retracement level from the whole move back over the last couple of years, I think you have a possibility of gold probably going into about the 1300 area. You see a lot of accumulation in this. This is I don't know whether it's a short covering or what, but a lot of accumulation. I mean, this is a big move to a safe haven. You have the RSI, remember we talked about if it goes over 70, that means that you are actually in a bull trend. I would like to see this come down. If it pull back, maybe we stay above 40. That means you're in a longer-term trend that's going to remain bullish. Again, we were very overbought, pulling back a little bit in here. If we can get down to this trend line, you could probably add to this position. I think that would be something that you'd want to possibly go into. Actually, we're at 117 today. It's up about 1.4%. So we're right in here. I might wait to go into this thing and down here about 114, 115, somewhere in that area. Now, if you go longer term on gold, you can see the 50% retracement on the longer term chart shows you that the 200-week moving average and the 38.2% fib retracement would get you up to about 1,300 on gold. If things would really fall apart with the global economies and all, your next target on that 50% retracement would be up here north of 1,400. So it looks like the longer-term trend in gold is bullish again. Since 2011, you've come down from almost 1,900 to almost this $1,000 level. So I think this is probably for your safe haven money. I think you could easily go in here. Now, what I do want to say that I do. If you're looking more for capital gains rather than just somewhere to park your safe money, this is the gold miners ETF, GDX. As you can see, you also have a big bounce off this. You broke a longer term, this is a trend line going back a couple of years. You've broken the descending trend line. You actually have taken out 38.2% of this retracement level. You're struggling around here. You're up again today. You're up about 3% on some of these things. I think you look at some of these stocks, if you want to play a gold rally, I think you can look at Goldcore, GG, American Barracks, ABX, Newmont, even some of the other mining stocks look good to me too. Newmont Mining, NEM, they all look pretty good in here. If you think the global economies are going to pick up a little bit and the U.S. dollar stays about where it is, that would trigger a commodity index, which would probably propel these things a little bit higher. Again, on the technicals, you can see some good accumulation in there. RSI got up to almost 90 something over here in this thing. So it's in a bull market at this place. I think it's got a longer term to play. One of the stocks that I mentioned on TV a lot, Freeport McMoran, it's gone from something like $2 to $7 off today. One thing about Freeport that you want to, unless they start to sell off, a lot of their assets, they're in trouble because they diversified into oil exploration and all back a couple of years ago when oil was trading at about $100 a barrel. So they're going to have to spin off some of their assets to stay afloat. And I think if you're in that one, you're probably just you're trading it for quick pops or shorting it for quick drops. But the other gold miners and some of the other ones like Newmont and American Barracks, I think you can probably buy those with a play on gold for the longer term. Okay, we're going to open up, look at a couple stocks here briefly, but before we do, I just want to take a broader look at some of the different sectors just to see where they are, if they're participating in this counter-trend rally. The first one we're going to look at is materials. It's been one that's been the third strongest over the last month. It's up about about 5.8% off of the low. We just actually crossed above the 50-day moving average. Nice positive divergence over here. The momentum's bullish. We're stalling up at that 70. I'd like to see this next run take the 14-day RSI up above 70 maybe. Accumulation is still not what you'd like to see. I'd like to stall over in here, but people are slowly buying into some of the commodity stocks. If you're looking at this thing and the market begins to improve in the next few weeks, you could probably get a rally into this thing from XLB from about 41, 42 up to about 44. So at that point, I think I would probably start to maybe peel off some of my gains in that. You also have MACD-LT, which is over the intermediate term, has finally gone bullish. That's telling you you're going to have a little bit more upside to go on that. As far as the longer term picture, again, when you look at these, it makes you less excited about whether this bull market's continuing on in some of these sectors. Here's a long-term trend line. We broke it back in September. Didn't even rally back up to it. Made another new low here a couple of weeks. Not even close to coming up and making a higher high over here. So we're probably going to run into resistance here. This 200-day or 200-week moving average. That's going to be formidable problems over there. We actually also broke this 38.2% Fibonacci retracement level, which opens the door. Actually, probably next support would be around this 50%. So if you see oil cracking again and goes below that 29 area or so and heads lower, you're probably going to see the materials come down here to this area where they were back in 2012. So I'd watch that. I do see the positive divergence in the RSI, which I like, but the other indicators aren't supportive that we're going to make a new run into higher highs on this. So I'll be careful. The longer-term trend on materials and commodities is still down. Okay, this is the energy spider. Again, we're getting a nice bounce on that over the last 30 days. We're up about 3% off this bottom. We actually just broke the 50-day moving average on energy spider again. That's with this big bounce in oil that we've had, which you can see. You also have some retracement problems here with this Fibonacci. Here's a 50% retracement from this low that we had from this move from the November down to the recent low, and also a 38.2% retracement of that total move down here just from going back from middle of last year. So you've got a lot of resistance in energy. Again, I think you're probably going to get topped out on this oil run, maybe 36, 37 tops. If it rolls over there, you're probably in trouble, but you do have some positive divergence. So, like I say, we're at around 31 something today. I would look for oil probably to get to around 35 or so. If you've bought some of these, you've hit some of these energy, oil and oil-related stocks, I think you can hold on to them and get a little bit more upside from here. But longer term, you look at this again, and we talked about this all last summer. Here's a long-term trend line. It broke it back in 2014, came up, wasn't able to get back above that trend line, broke the 50% retracement of this whole move, broke the 61.8% retracement of this. And usually when this happens, you see this retrace the total move. So the indicators, although you have a little bit of positive divergence over the short term, the accumulation is down, MACD is down, and I think that this definitely is just a counter-trend rally. It's going to take a long ways to work out. I'm running over again, but I'm going to try to cut this short if I can. The financial sector, Financial sector is actually down over the last month, 1.2%. It's trying to struggle over here at this 50%, or actually the 38.2% retracement. This moved down from the December low, where it really fell out of bed. That's kind of telling you that the bank problems aren't all done yet. They still face problems with the oil loans, and also this negative interest experiment that we're in right now. We don't know how that's going to weigh out on all these financials. So I'd be a little bit leery about that. The only thing that's going to make me want to go into this would be if we see more hikes with rates, and I don't think we're going to see that for a while. We're just not getting supportive economic data on that. And in fact, we've had a narrowing of the yield curve, which again cuts in on the bank's profits. So this is more of a trade. If the market looks good and you get a trade up here on the XLF to around 2250, 23 area, I would lighten up on those. Longer term, actually a little bit better term in the long term. You've just broken the trend line from 2009. If it breaks below that again as we weaken in here, you're probably going to get a retest down here of this below 20 on the XLF. You'd probably find some support down here at this 38.2% retracement line. But you also have, you don't have the positive divergence on the RSI. The MACD has gone negative, and the up-down ratio here is showing a lot of distribution in the financial sector. So I stay away from that. Industrials, that's actually the best performing group, 6.7% jump off the bottom, coming into resistance up here around 53 or 63 around that area. We've gotten positive divergence. You're seeing some nice accumulation. I think what's really helped on this is we were worried over in here about the strength of the U.S. dollar and how it would affect international industrials. Okay, as long as we're going to keep our the dollar kind of where it is to maybe even a little bit softer, that's going to help this, because remember they were facing some headwinds with about currency risks over there. It was going to cut about 3 or 4% of their earnings off of that. So again, this has a chance to make it up here a little bit higher. It's been one of the leading performers. As the market goes up, industrials look okay. Longer term, again, we broke the long-term trend line, came down here almost to the 200-week moving average, bounced up the trend line. Will it be able to climb back above there? Not so sure. Accumulation is still showing distribution, and again, the MACD is still negative. A couple more. Tech seems to be going sideways, not doing too much here. We are seeing some bullish divergence and positive divergence of the short term. Not a lot of accumulation. I think that's probably because a lot of this move is in some of those high momentum stocks. Longer term, we actually just broke this. It's struggling to hold this long-term trend line in the tech thing. If we roll over and it comes down and takes out this double bottom on the XLK, that would spell trouble, because it's been able to find that this 39 and change area, 1, 2, 3, about 3 times over here. So that's formidable support. So you want to watch that area. If we roll over and it takes that out, you're going to open the way for the techs to probably sell off, especially in the high momentum stocks. A couple more here. These I do like. If you're looking for a place to park some money, this is XLP, Consumer Staples. It's close to making new highs, which what you want to watch over here is you're making a triple top. I don't know. But you're going to get a point and figure buy signal off of a triple top breakout over here. If you can break through a new high over here, that's something you want to watch. You're also seeing positive divergence over there, accumulation, MACD intermediate term trend is up. This is one that you want to take a look at. Maybe your Procter & Gamble's and some of these stocks, which also pay the better dividends. Longer term, you haven't even tested your long-term trend line in this sector yet. So again, it's outperforming and looks like it's going to continue to outperform over the near term and the longer term. Healthcare spider, you just made another new 52-week low. The problem with this is actually the problem with this. You haven't even made it up to the 50-day. And although some of the stocks like Merck and Pfizer and some of these, paying dividends, the more conservative defensive stocks look okay. What's going on with the biotech industry is just annihilated the healthcare spider. And I think that as long as you pick up the big cap names, you can do okay with those dividends and all. Okay, I'm going to try to wrap this up. I've gone too long again. I may not even be able to go into any questions, but here's the healthcare long-term spider. Again, you've got some more downside looking on this thing. But this is I'm getting ahead of myself. This is a consumer discretionary spider. Again, it's one that looks good. You're up here challenging your 50-day moving average. You did make a lower low over here, but I think you can get a rally on with the Home Depots and that if the market continues higher up here to this 200-week moving average. Long-term, it also looks better. It just came down and tested the long-term trend line, bounced off of that, could get up here to the 50-week moving average. You want to watch that longer-term trend on that because I'm not seeing a lot of positive divergence in the longer-term technicals. Okay, last chart we're going to look at here. This is the Dow Jones Industrial going back to about 1986. And what I want you to look at over here is we've had two bear markets that were pretty significant going back over here. And what you're going to notice on this is the MACD long-term, which we use for the longer-term trends, has gone into negative territory twice. That was back in the 2002 bottom, and also back here in 2008 when we had the financial crisis. The MACD also went negative. So if you can keep pulling this thing up, because as you can see over here with this pullback, the MACD is again right at that zero line, and if we go below that, that's probably signaling that that we have ushered in a bear market, and we're getting close to that. So what I've tried to do just to wrap this up, we are still in a counter trend rally until we can actually take out some of these highs, at least from December of this past year. That was support that we could move higher. But until we see that, you have to treat this as a rally that you can sell some of your positions when we get up near these resistance lines that we've talked about today. Okay, now when you're just one last thing I want to put in these. We've looked at these numbers today that they're going to give you clues in the market that have violated either upside or downside. Because these are going to trigger the next move either way. And just as those numbers will alert you that a rally or sell-off is stalled, when you forecast market direction, which is almost impossible to do, you look at those lines and you look at those indicators, those lines that we drew in here, internal breadth numbers. Then you take your best guess from experience and decide which way you think the market's going to go. And then you take your best tip to see what takeaway is. As a trader and investor, the worst thing you can do when you look at these charts is determine that you're right, the market's wrong, and that it's going to reverse and go your way. What happens in that is you enter into a trade, and what happens is you hope, your research it comes down to, I hope it's going to turn around. That's not the way you want to make money. Now, you don't have to flip in and out of these things, but when you see these numbers violated, that means you can add to your positions because the probabilities are that this market's going to go higher. As the market turns around, takes out some of these support levels that we talked about today, then you're probably then it's telling you that the market's going to go lower. If you can miss most of these moves over here where you're down 35-40%, that's the way you cut your losses. You only have to guess right on these market moves, 40 to 45%, and you're still going to make money. But if you hold on to it through one of these periods over here, you're going to get crushed, and that's you can lose almost all the gains you've made over years. So the rally looks like it has a ways to go over the short term, but the majority of these indexes in the sectors are still in a downtrend, and until we can see a pattern of some higher highs and higher lows, until that changes, we'll treat this thing as a counter trend rally. I think we could probably see it move higher for the next 2 or 3 weeks even. At that point, we'll reevaluate, and unfortunately, like I say, we didn't get to any questions today. I hope you got something out of this. If you have some questions, send them to Dr. Market Edge at marketedge.com or support at marketedge.com, and I'll try to get to them individually, or we can talk about them next week. Okay, thanks for joining us.